There is a massive unspoken gap in the world today, a silent divide that quietly separates the people who will spend their entire lives working exhaustingly for money from those who have figured out how to make their money work tirelessly for them. It is the stark difference between staying perpetually stuck in the loop of the rat race and eventually stepping out of that cycle entirely. It is the boundary between trading your finite time for income forever and reaching a point where your accumulated capital generates uncompromised freedom. Most people are taught to work hard, climb the corporate ladder, and save what is left over. However, very few are taught the mechanics of how to actually detach their physical labor from their earning potential. According to Albert Einstein, this wealth gap is driven by what he supposedly dubbed the eighth wonder of the world. He summarized its power with absolute simplicity. He who understands it earns it. He who doesn't pays it. He wasn't talking about the laws of relativity or advanced astrophysics. He was talking about the financial miracle of compound interest. Over the next several minutes, you are going to understand exactly what that phrase means, why it holds such unparalleled power, and how you can actually leverage it to build real, sustainable, generational wealth. Let's strip away the Wall Street jargon. No complicated economic theories, just clear logic and real numbers. Before we can fully appreciate the extraordinary, we first need to understand its predictable cousin, simple interest. Imagine for a moment that you have $10,000. You put that money into a vehicle that pays you a flat 10% interest rate per year. After 1 year, you earn $1,000. After 2 years, you earn another $1,000. After 3 years, another $1,000. Every single year, it is the exact same story. Your money is growing, but it is growing in a perfectly straight, linear line. It is predictable, steady, and painfully slow. It will likely never make you truly wealthy, especially when you factor in inflation, which constantly erodes your purchasing power over that same timeline. Now, here's where the mathematics shift. Compound interest does not just pay you a return on your original money. It pays you on your original money, and then it pays you again on the money that your money has already earned. It is growth generating its own growth. Think of it like rolling a snowball down a long, snow-covered hill. At the top, the snowball is tiny. You pack it together and give it a push. At first, almost nothing happens, but as it rolls, it gathers more snow. Because it is slightly larger, its surface area increases, allowing it to grab even more snow on the next rotation. Eventually, it becomes an unstoppable avalanche. Let's go back to that $10,000 investment at a 10% annual return. In year one, you earn $1,000. Your balance is now $11,000, but instead of withdrawing that $1,000, you leave it. In year two, you earn 10% on $11,000. That is $1,100 in interest. Now, your account sits at $12,100. In year three, you earn 10% on $12,100. That amounts to $1,210. Something profound is happening. Your interest is generating its own interest. At the beginning, the dollar difference feels negligible, but over a long enough timeline, it explodes. Our human brains are wired to think linearly, not exponentially, which is why most people underestimate this power. Let me illustrate this with a powerful example. Two people, the same investment, the same returns, completely different outcomes. Meet Sarah. Sarah starts investing at age 19. She puts $300 a month into the stock market, earning an average of 10% annually. She does this for 8 years. By the time she turns 27, she stops completely. She never contributes another dime. Total money she invested? Just $28,800. Now meet David. David waits. He spends his early 20s enjoying life. At age 27, the moment Sarah stops, David starts investing. Same $300 a month, same 10% return, but David keeps going for 38 years straight until he is 65. Total money. David invested $136,800. Who ends up with more? David invested 4 times more money and stayed consistent for decades. At age 65, David has about $1.3 million. That is life-changing. But Sarah? Sarah ends up with over $1.8 million. She has $500,000 more despite investing $100,000 less. It is not magic, it is time. Compound interest rewards time more than talent or effort. The earlier your money starts, the longer it compounds. This early advantage becomes impossible for latecomers to catch up to. In the beginning, compound interest feels disappointing. Your money grows slowly. This is the valley of disappointment. This is where most people quit. They sacrifice for a few $100s in gains and think it's not worth it. But compound growth isn't linear. It is exponential. At first, the graph is flat. Then it bends upward. Eventually, it goes vertical. In later years, your money accelerates. Or you might earn more in a single year at age 55 than you did in your first 10 years combined. That growth is the payoff for patience? Let's make this practical. To have $1 million by age 65, assuming a 10% return, here is your monthly requirement. Starting at age 20, $95 a month. Starting at age 30, $260 a month. Starting at age 40, $800 a month. Starting at age 50, $2,400 a month. The later you start, the more painful it becomes. Time works against you if you delay. That is why waiting is the most expensive decision you can make. Where do you put your money? A savings account earning 1% is losing value to inflation. To make this work, you must deploy money into assets that grow. First, eliminate reverse compounding. This is high-interest debt like credit cards. If you pay 20% interest while earning 10%, you are losing. Second, you don't need to be a genius. Most professional managers fail to beat the market average. A simple strategy, like broad market index funds, allows you to own pieces of the top companies. As they grow, you grow. Third, consistency beats intensity. The biggest threat is your behavior. Skipping months or panic selling ruins the curve. Automation is the solution. Set it to invest every month like a utility bill. No emotions. Just consistency. Wealth isn't built in one big moment. It is built quietly. $100 here, $300 there, month after month. Society thinks wealth comes from hitting a jackpot, but real sustainable wealth comes from discipline and letting time do what it does best. You don't need a lot of money to start. You just need to start. The longer you wait, the steeper the mountain. You cannot go back to age 19, but you can start today. That decision is what your future self will feel most. The best time to start was years ago. The second best time is today. Start small if you must. Stay consistent. Let the eighth wonder of the world build your fortune. It is not about working harder forever. It is about reaching the point where your money starts working harder than you ever could. Once that happens, everything changes. Imagine a life where your expenses are covered by the growth of your assets. That is the definition of freedom. It isn't reserved for the lucky. It is available to the patient. To maintain this momentum, you must understand the psychological hurdles. When the market drops, most people see a loss. The person who understands compounding sees a sale. They see an opportunity to buy more snow for their snowball at a lower price. This mindset shift is what separates the wealthy from the middle class. While others are driven by fear and greed, you must be driven by the math. The math tells us that over decades, the trend of human productivity and innovation is upward. By owning index funds, you are betting on human ingenuity. Finally, remember that the snowball takes the longest to get through the first few rotations. The first $10,000 is the hardest. The first $100,000 is a grind. But going from $100,000 to $200,000 happens much faster. And going from $500,000 to $1 million can happen in just a few years. This is the bending of the curve where your previous interest does the heavy lifting for you. You are no longer pushing the snowball, it is rolling on its own. This is the path to escaping the rat race. It is not a secret, and it is not a scam. It is basic mathematics combined with human discipline. Most people won't do it because they want to look rich today rather than be wealthy tomorrow. They choose the luxury car payment over the $800 monthly investment. They choose the instant hit of dopamine over the long-term peace of financial independence. But now that you understand the true cost of waiting, the $500,000 gap between Sarah and David, the choice should be clear. Don't wait for a better salary. Don't wait until your debt is perfect. Start with something, however small, and let time begin its work. Your future self is depending on the decision you make today. Reach for that freedom. Understand the eighth wonder and start earning it.